Hello and welcome back to the channel, everyone. So in this update, I'm just going to be going over a couple of my buys, but also a couple of exciting things happened this week. In the month of October, I actually passed the $100 mark for earned dividends. So that's incredible. I basically earned $100 doing absolutely nothing and just collecting my dividends. So it's a really nice milestone to achieve. I'd like to obviously increase that average to $100 every single month, but receiving it in any month, even my highest paying month, feels pretty special. That this experiment is working, and I'm just going to continue adding money to this portfolio and just increasing my passive stream of income over time. So if you want to follow along with the journey, just hit subscribe, like the video, and let's get into the intro. And the portfolio value is $17,852.09. In the personal account, I have $5. So this isn't one that I actually use. I'm still trying to fill up my RRSP for my retirement account and my tax-free savings. So the $5 in here is actually from a reward from someone using my sign-up link for WealthSimple in the description below. So thank you, Edel, so much for using that, supporting the channel. I get a little bit of money, you get a little bit of money, so hopefully you got a little bit more than $5, but I do appreciate the sign up, and I will use the $5 to grow my passive stream of income even further. And if you're new to investing, we're in a down market, pretty good time to start investing. A lot of people, start investing when the market is good. That's the opposite of what they should be doing statistically, just because people are just too emotional when it comes to investing. They really need to educate themselves in the fact that you want to be buying when things are bad, when there's total panic and uncertainty. That's when you want to be buying stocks. So yeah, feel free to use that if you haven't yet, and help support the channel. Give yourself a little bit of extra cash. And the RRSP is actually the best performing portfolio so far. We're up 18%. I only hold one stock in this portfolio, and that's Starbucks, and they had phenomenal earnings. So Starbucks performed quite well. Their earnings beat expectations. They're increasing pricing. Everything's going good for them. So the revenue came in at $8.4 billion, so their top line was higher than expected. Their earnings per share was higher than expected. And one field you really want to pay attention to for a retail business or any kind of restaurant or store is same-store sales. So in the U.S., they increased 11% versus 7.78. So that means without opening any new Starbucks locations, they increased sales in the United States by 11%. That's incredible. Internationally, not doing as hot. They actually contracted 5%, but the analysts were expecting minus 8%. So actually they're doing better. So this could be a sign of, maybe a reversal in the overseas markets. Maybe they're getting a little bit better. We can see even the China sales are, getting a little bit better despite all the lockdowns. So 16% decline. They're expecting 21%. But overall, the revenue came in 3% higher overall. And just the U.S. growth is incredible, and the most important thing I want to look at for Starbucks is actually the use of their rewards loyalty program. So people basically use the Starbucks app, they put money on there, they give Starbucks essentially an interest-free loan to use into their business and reinvest it at a very high rate of return. So that rose up 16% compared to a year ago. So this is just a great way to get people into the store more often and loading their cards. And, Starbucks is basically almost like a bank. They have like $1 billion in this that's like unused. So essentially people pay them before they even get the product. So that's a great sign to see going forward, and it definitely keeps customers coming back. And after the earnings on the next, the next day, Starbucks shot up a lot. So it was in the low mid 80s, and then it rose up to a little bit over $90. Overall in the RRSP, we're up $100 or 19% all time. 10.2% is just from Starbucks itself, and then the other 8 or 9% is simply due to the U.S. currency outperforming every other currency in the world. So because we hold an American company in American dollars, we're kind of benefiting from that right now. So it's kind of nice. This portfolio is doing well. And now let's get into the TFSA. For the TFSA, we're up 177 over the past day. And then all time, we're just down 6% or down $1,000. So this one is, climbing back up. It's been more in the red lately. But overall, in the time since I've started investing, I've mostly been in the green. So, this is just temporary. Stocks are volatile and it's fine. My main goal is just to create passive income through dividend paying stocks. And then I don't need to worry so much about the value of the companies at any time. So Apple is in a little bit of a decline. So this one's in the red. It's been in the green mostly for me. So unfortunately, it's in the red right now. But I know it'll bounce back eventually. And then Algonquin Power, I bought one share going from 50 to 51. Just really liked the price, so decided to buy one more of these. ATD is performing really well. It's basically almost at all-time highs, over $60. So international convenience store company. They also own gas stations. Great little stock. Pays a little dividend, not too big, but they do a lot of buybacks. They have a very low payout ratio. They have a lot of growth potential because they're an international company. Aritzia also doing very well. It's a clothing retailer, luxury, and it's growing very, very fast in the United States. And I plan to hold this for the long term. That's why I'm not selling it, for a quick gain, because I think this company has a lot more room to run. So we're not selling this one. It would have to go up a lot more for me to consider selling it. It would have to be really overvalued for me to just sell it right now, because I do think that the company is in a great spot and will continue to get better over time. And then for Scotiabank, we actually increased our position. So I bought about 40% of a share, just getting up to 22 shares. Just going to take advantage of the declines in the Canadian banks. Just great, solid dividend payers. Never missed a payment, so getting these while they're out of favor is never a bad idea. And I also picked up a little bit more Google. So I bought about 60% of a share of Google. I just think at these levels, it's just priced so low, and the expectations are so low on Google. I plan to just hold this for, maybe 5 years, maybe 10, and then sell the stock and then maybe put that into a dividend pair, just because I think that it's just priced way too low. I value this a lot higher. I definitely think that it's worth over $100 easily. So this is just kind of a very easy stock for me to buy. So definitely going to average more into this, especially if it stays in the 80 range, because it's been sitting at 100 for so long. So I'm definitely going to take advantage of this decline and buy a great company while people are doubting it. And then I also bought one more share of Power Corp of Canada. So they own a lot of insurance businesses, and they even own a majority stake in the WealthSimple app. So bought one more share to go up to 27, just average down. Again, the financial sector in Canada not doing so hot. So just getting this while it's down. For Smart Centers Real Estate Investment Trust, I just got one more share, going from 35 to 36. So this is just giving me, just a pretty good yield right now, and it's a position I definitely want to grow. I kind of want to get about 5% Smart Centers, and then maybe add Granite REIT. That's another REIT I really like. I used to have it in the portfolio, but I sold it to get more of the Canadian banks at the time. I just thought that the Canadian banks were more of a bargain. So I sold it out at like 98, and now it's sitting at like 70. So a kind of fortunate timing with that reallocation of money. Even though the banks went down too, they didn't go down quite as hard as Granite did. So I'm definitely interested in getting into the position again. And then for Telus, they actually had fantastic earnings. They beat on the top line, they beat on the bottom line. And also they announced a dividend increase of 4%. So that's fantastic. That's money I did not have to work for, and it's just additional income in the money without me having to put in additional money or even reinvesting a dividend. And just from that raise, I increased my passive income by 13 cents a month, basically forever. And that's assuming that Telus never raises their dividend again. But as we know, that's not the case. Telus actually raises their dividend a lot. They raise it, twice a year, every single year, and they plan to keep raising the dividend between 7 to 10%, at least until 2025, and then they'll see how they do from there. So fantastic company. We gotta love our Canadian monopolies, and just take advantage of them, and might as well profit. You pay a very high phone bill, you might as well own the company that basically has you, and you have no choice. You have no options in Canada for mobile carriers, and I don't think that'll change unless something drastically happens with the government. This is as safe of a monopoly as you can have. And then for TD Bank, I just bought a little bit of it, so just a couple dollars in here, just averaging into the position a little bit more. I'm going to try to roll this up to 19 shares the next time that I make a deposit. And for the dividends earned, we've earned $890.83 since starting the portfolio, with the portfolio yield being about 4.7%. I want to get this up to 5, so I'll be focusing more on dividend-paying stocks than non-dividend paying stocks. So that's why I'm still gonna buy my non-dividend payers a little bit if I think they're great value. So Google right now I think is a great price. Microsoft not as much, but still a fantastic company. I'd say Microsoft is a better company than Google, so it deserves to trade for a higher price. But right now I think Google's a great time to add it. I have no doubts about the company long term at all. In 5 to 10 years, I think you'll be very happy. The next couple years, is anybody's guess. Then annual dividends, I now earn $900.99 per year in dividends versus the last update, which was $890.44. So about $10.50 extra every single year just from dividends alone. So nice little increase. Monthly, we went up from $74.20 to $75.08, so almost an extra dollar per month. So pretty good increase there. And again, 13 cents of that was from Telus raising the dividend 4%, and that had nothing to do with me putting in more money. So our stocks are raising their dividends too, and that's giving us an even bigger push in the long term, trying to build a passive stream of income that can, hopefully replace some of my active income over time, to eventually doing it completely. And then weekly, we went up from $17.12 to $17.33, so an extra 21 cents a week, not too bad. And then on the daily, we're up from $2.44 to $2.47, so an extra 3 cents every single day. We're inching closer and closer to one of my goals in the portfolio, which is to make $3 per day in dividends. Just every time I go to sleep, I wake up, $3 every day. $3 just produces itself and appears out of thin air. And then the months to earn $100 is how I'm keeping track of the compounding effect, or the snowball effect, as dividend investors like to call it. So it last update was 1.35 months to earn $100 in dividends. Now it's down to 1.33 months. So this number continues to decline as I keep investing more money and reinvesting my dividends. Hourly wage, the portfolio is working hard, but no raise from work this week, so still at 43 cents per hour. And then I just want to go through some of the goals I have here. So I've been trying to hit $3 a day for a while. It will happen eventually. I just have to keep buying dividend-paying stocks. And if I get months like this in October where I got over $100 in dividends, it's going to come a lot sooner than I think. Just comparing October of 2022 to 2021, 161, and then October was 38.75. That's a giant increase in 1 year. That's almost triple the amount of passive income in just a single year. And then another goal I have is to earn $100 a month on average in dividends. So it's nice to receive it, on my highest paying month when most of my companies pay me, but I would like to get that to be my minimum for every month, or at least my average. So that'd be a nice goal. And I also want to reach $1,000 in annual dividends. We're already at 900, so this is definitely going to come eventually. And then if we look at the dividends earned year over year, in 2021, I earned $261.80. And then in 2022, I earned $629.03. And we still have most of November, and we still have December paying us more dividends. So it looks like we're going to nearly, if not triple, the amount of dividends I earned in just a single year. So that's a fantastic increase. That's why I really like this style of investing. Even though the market is volatile, my stock prices aren't really, going up like you'd want them to. The passive income just continues to go up in a very linear line, and you can even see in my growth and my dividend payments from 2022 compared to 2021, it's already like a pretty big difference. So if you enjoyed the video, please like the video, subscribe to the channel, and let me know in the comment section below what's your favorite dividend stock.